Now, Bill Belcher, who's the Chief Global Economist at Mirae Asset Securities, joins us now on the show. Bill, morning. Great to have you with us. First off, let's discuss India's balance of payments position. Do you think that, as well as the current account deficit, is a matter of grave concern? And how do you view India on these parameters vis-a-vis its global peers?
Well, actually, I think India will get a bit of a respite on the external side. Clearly, its exports will be hurt by the slowdown in the West, but what may help it a bit more is that we do anticipate commodity prices, in particular oil prices, to come down a bit here, and that will reduce the import bill of India, take some of that external constraint off of them.
Well, and how do you view India's GDP growth compared to its global peers?
Well, India will continue to outstrip its global peers. I mean, we don't expect growth to slow down below 10%, below 6% in the worst case scenario, but it's going to disappoint its expectations of growing 8 to 9%. We don't think that's possible. We think something more like 6.5% is reasonable for this year.
Right, and additionally, Bill, then what's your view on inflation specifically? How far do you think inflation can rise and impact the GDP growth if fuel price hikes take place?
That's a good question. I think that fuel price hikes have to come about. India has to address its fiscal deficit. It is the one thing that is really deterring foreign investment flows into the country right now and raising medium-term concerns. In terms of inflation, India, let's forget the fuel price hikes. India really has to relieve the supply bottlenecks in the infrastructure sector. That's what's going to bring down inflation. Without that, they're going to continue to bump up against the supply constraints. That turns into inflation, and growth has to slow down. And right now, it looks like we're down around a 6.5% rate. That should send a very strong signal to policymakers that action's needed.
Okay, and how do you see the inflationary expectations panning out over FY13? Do you think it will rise considerably?
Well, we don't think there's an immediate problem because import prices should remain down. I mean, you look across the commodity spectrum, almost everything has moved down this year in your broader categories, and most important, oil. So that takes some of the pressure off of India. But again, the supply constraints remain just lurking in the background, just below the surface here, and those will be exposed when the economy begins to grow strongly again if these bottlenecks have not been relieved.
Right, and Bill, additionally, what about the fiscal deficit target for this year? Do you think that India will be able to meet that FY13 target?
I think with slowing growth, it's going to be very difficult to do that. You may get a little bit of a break from the oil prices and the oil subsidies, but it's going to be very hard to make that cap given the slowdown in the economy.